Today's analysis is different than my daily analysis videos in that this is a prepared presentation instead of a cataloging of my real-time analysis. It is a bearish chart, but I will be addressing the bullish reversal potentialities, so there's something in here for everyone. Buckle up, let's get into the charts. Starting today's analysis with a candlestick pattern that I didn't see yesterday. I want to go onto Bulkowski's website, thepatternSite.com, and go ahead and navigate to the candlestick index, candlesticks. Okay, Bulkowski on candlestick patterns, great webpage. He's got them all listed here in alphabetical order. He does also have a visual index, which is really nice. So you can go through and just have a look around and try to see if you see a pattern that's on the chart that's also on the web page. So here we go, identical three crows, that's what I want. The three crows candlestick pattern. He talks about the book, of course, he's published this information is. He says that the identical three crows candlestick is one of the better performing patterns, but that is probably due to its height. When price trends lower for three candlesticks in a row, tall black ones no less, almost by definition the trend has changed. The candle is supposed to act as bearish reversal at the top of a trend, and it does, ranking 4, where 1 is best out of 103 candle types. However, identical three crows are so rare that I only found 921 candlestick patterns to study, down from the usual 20,000 that he likes to see. So when he's doing his statistical analysis, he is using massive sample sets, and that's why the information is so reliable, because it's so thoroughly tested. He says that the performance numbers are suspect, meaning they could change dramatically should more samples become available. That means that this pattern is bearish, performs very well, but it's also pretty rare. Kind of like a rare Pokemon. So I'm gonna go ahead and zoom in on these three candles here and we can take a look at them. They aren't super tall. They really aren't super tall, but if you include the wicks and the tails, yeah, they are. These are, I was saying not all last week, but last week I said I was looking for three $2 drops. Here we have a high of 1866 and a low of 1730. So there's a $1.50, right? 70 cents to 18 and then 66 cents. Yeah, it's like a $1.50 there. And then we had a high of 1807 and a low of 1666. Kind of a $1.50 there too. And also here, 1761 with a low of 16.1, a $1.50 there. So maybe $2 was a little high on my candlestick height. A $1.50 seems to be perfect. And here they are, 1, 2, and 3. I didn't know that this is what it would look like. I've been expecting a vertical run down, which would be a lot steeper and a lot harsher, and maybe that's what's to follow here, as this is a very, very bearish pattern. Let's scroll down to the identification guidelines really quick and just confirm that we have this, okay? He says, look for three tall black candles, the last two opening near the prior candle's close. So open near the prior candle's close. Opens near the prior candle's close. So it's a little far. It's not super close. What was this close at? This was at 1685 and this opened at 1712. I mean, yeah, okay, that's, at 17, near 17. I'll take it. Some sources require each candle to be similar in size, but this one is rare enough without that restriction. And actually, we have that. We meet that. We meet that. We don't need to say that. We can say, yeah, that they all are the same size, which is great. Here's the catch. The price trend leading to the pattern needs to be upward. And if you look at this chart from the $34 high, the price is not in an uptrend. It's really not. But if you do a careful trendline study, you will see that there is an uptrend that precedes these three candles. What? Yeah, I know there is. It surprised me too because I didn't see it all this week. So I want to start by just starting my trend line, and I do that by finding the lows and the highs. You know what, maybe I just squish this down a little bit. I'm not looking at my indicators right now, so I'm going to prioritize my screen space. You start at the low, and then you draw a line to the high. Now, you don't want to overlap any of the price between those 2 points. And as you can see, the second candle from the low actually is right in the way. So the rule is that you drop the angle of that line until you don't overlap that second candle. And when you do that, something awesome shows up. You can see that on this day that the price touched and moved higher. I'm going to zoom in a little bit, and by that I mean I'm going to go into a smaller time frame. And I do this because when you draw your trend lines on a daily chart, you see how far I was from the actual low, and you see how there's a little space there. I'm going to go ahead and tighten this up. So I'm going to click it. I'm going to move it over very carefully place it right there, and zoom out again. And on the 15-minute time frame, you can see what this looks like. The price came down, beautiful touch, moved up, and then boom, crashed right into it off of the open. Pipe bottom, right? Just about. And a pull back up. This would be the test of the breakout price. And then a lower low comes in right there, and this is a really bearish thing. This signals that this uptrend was broken, and that's confusing to have that in red. Let's put that in green. That threw me off. Geez. There we go. Yeah. So the following day really signaled that the price was going to dump. And sure enough, it did, right? So now that we have this uptrend established, let's go back out and draw our downtrend. So we find the high that preceded this breakout, which is way up here, right? And I'm going to draw it right there at the high and find the lowest low, okay? And I'm going to exclude the last 3 trading days, the 3 black crows, the 3 identical crows, which are right here. So, and as you can see, there was this inverted head and shoulders through here. So what do? Which low do you use? Now, the second low is actually 3 cents higher than the first, but they are essentially the same price, and I have found it most beneficial to use the second low. And now I want to make sure I'm not overwriting the price at all. Whoops. That's what I get for right clicking. And that would lead us to right there. And so you can see that the top of this candle is really what dictates where that line goes. This being the low that we don't want to, that we're starting from. And I'm going to scooch this over a little bit too, make it even cleaner. Give me as clean as it can go. Oh, that's right. And then I have to rise. Okay, yeah. So it stops right there. And then it bounces. It bounces right there. What's this? Higher, high, higher, high. Our lows are also rising. There's an uptrend right there. Okay, there's the low. And if you go up to the top here, and then boom, right there. You can make an internal trend line, and I say internal because it actually cuts off a couple of tails right there, right? So here's your uptrend. It lasted about a day and a half, and then there was a breakout, and you had the 3 black crows follow. All right, 1 day, 2 day, 3 day. The first crow broke that uptrend. Now, if you want to get really picky, you can say that, well, not picky, but if you want to draw a perfect external trend line, which means that we really don't overlap the price at all, that drops that trend line way down here. And you can see how the price moved below, came back up and rejected, all right, pipe top. And then boom, fell, and fell. So this looks a lot like the candles we saw happen around the breakout of this guy, right? You see this? Pipes. Pipes are a great candlestick pattern. I trade pipes all the time. So we do see that the price is in an uptrend. There's the external trend line. I'm going to duplicate it, and I'm going to show that internal trend line again. You can see how both of these were very good trends to draw, and they did precede the 3 black crows. 3 identical crows. Black crows, that's so redundant. I'm going to zoom back out to the daily now, and we'll have a look at what that looks like. There you go. Teeny little uptrend in there. Teeny little uptrend. And I think the reason why that uptrend was so short is because there's a bear flag in here. It's a very, very strong flag. I'm just gonna pull this out. There you go. And I'm gonna use the low from the end of the downtrend actually. So let's take this high, which is 1901. And I know I've been drawing this bear flag all week, but I'm actually going to do a price target on it and such. And now let's do this low here, the last candle of our downtrend, 1697. 1697. I think this is our best expression of the bear flag. Boom, 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 boom. Now bear flags need to be less than 3 weeks long, all right? So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. Perfect. And this last crow here establishes the breakout of that flag. So let's pull up the webpage on flags really quick. It might seem a little basic. Everyone knows what a flag is. That's not true. That's not true. Most of the flags I see on YouTube are not flags. There are identification guidelines, and who or what establishes what those guidelines are? It's the guy that ran the statistical analysis. Because to make the statistical analysis, he had to come up with defined terms, boundaries, rule sets. You had to put it into code, right? So this is, in my opinion, the place to get your identification guidelines. It's from Bulkowski. Here's our requirement that flags be short. Our trend lines need to be parallel, and here they're horizontal, so it's really easy. And you're going to see that the upward breakout is the most common. But really, flags tend to favor the inbound trend. So our measure rule is pretty, it can be done in one of 4 different ways. It's either the full height of the flagpole, which here makes no sense. With a high of 34 and a low of 1697, your price target's going to be like $1. So we don't, I'm not doing, that's a little extreme. The other 2 targets are just like the start of the inbound trend. You compute the height from the start. Okay, so you go from the top to the bottom of the flagpole, and then you apply the percentage mean price target, which is going to be at the top of the page, just above his ID guidelines, 46% for up and down. So I'm going to do that right now. I'm going to pull up this calculator, and we're just going to do a little bit of price target calculation. So a high of 34.33 minus that low, we're going to say 1697 equals that, multiply by 0.43. I think I might have done this in yesterday's video too. $7.98 is what we're going to take away from the breakout price of 1697. So I do that by making it negative and then adding it so I don't have to click it as many buttons on the calculator. $8.89. Okay, that's the flag target. I'm going to duplicate this. We're going to pull it down. We're going to name it bear flag target. Kabang! Bear flag targets. Control, paste. Give me 3, yeah. And go. Whoa. Where is it? Oh my goodness, it's so low. It's so low. But that's the target for that flag. Watch what happens if I duplicate that flagpole and pull it down. You know, you can see the price, it just goes to 0. So that's why I use the percentage mean price target measure rule. 898 is realistic for this kind of a decline with this kind of a flag setting up. It's a tight flag too. This is tight. Loose and tight flags are a big deal. The overall, here you go, loose or relative tightness of the flag can greatly contribute to its strength once it breaks out. Here's a loose flag and here's a tight flag, and we have a tight flag. Only a little bit of space here on either side of 2 candles, but really it was just back and forth, rectangle style. So wow, that's a bearish price target, and I'm keeping that up there. 898. That's a great price target. So where do we go from here? Well, let's zoom back into the 15-minute chart, and let's talk about breakouts. This is a very important skill to learn if you're going to be day trading, and I do this all the time. You can see that a touch occurred there, but there was a bounce. The first part of the breakout occurs when the price actually crosses that price trend. And when the price does reach this, I say, hey, downtrend or uptrend support is testing. I call this testing. And then when it breaks out, the price needs to rise back to that breakout price. So this is testing breakout price. And then make a new lower low. And once that lower low comes in, that confirms the breakout. So it happened once there. Now let's go down here and watch it happen here. You can see that there was a breakout and the price did rise to that level. And because it was on an open, we got this really wild price swing. But you can see the price did come up a few candles later, also test it, and then broke down. So what's it going to take to break this new downtrend that we have right here? There's our low. And now let's make sure we don't override the price at all. That would be up here. I do want to draw an internal trend line as well because those are also valuable. And I'm going to take it off of the second peak right here. And I do that because this is a pipe top and these kind of patterns can appear above or below the trend lines themselves. So here it's above. Look how close the price is to that internal trend line. It's very close. And this is where we're going to talk about bullish reversal. So because the three identical crow pattern is strong, very, very, very probable bearish breakout down. If the price does move up, that's going to be a statistically unlikely push higher. AMC loves to do that too, right? Here's a head and shoulder, right? You can see that it's really clean. And if we're going to talk about fractals, why couldn't this inverted head and shoulder be the first shoulder of a bigger inverted head and shoulders where the head is right here? Very possible. So if the price rallies and can get above 1697 after breaking through these trends, then I would expect a rise to the 1730 level probably. Let's start drawing lines on charts. I would expect, let's change our automatic lines here. Let's just make this yellow. I like to do future price action in yellow. So yeah, this is what I would expect to see in a bullish reversal. Okay, and then a higher high. And it'd probably be like a measured move up. I would say that's probably a good spot. This is all hypothetical. This is very speculative. So I wouldn't put a lot of weight in here. But if this was inverted head and shoulders, we'd have, it didn't save my yellow line as default. I don't like that. Go back, save as default. Thank you. If those are our armpits, then our breakout target would be really high, right? Yeah. Up towards 1895. And that makes sense going to the start of this downtrend or the top of the bear flag. So that's what bulls are looking for. They're looking for an inverted head and shoulders setup to play out, and that would be a pullback into the bear flag. And that doesn't even nullify the bear flag. It just means that it's going to take longer to play out, and AMC loves to take its time. I personally don't see that happening. I will be keeping an eye on it though. What I think is most likely is we get a push higher off of the open volume, and then maybe a topping pattern up here before a dump. And it might even be like a nothing burger day, where it's like a green day technically, but it's got like, a little body. This is very likely, because what I want to see it do is just go straight down. Because that's the easiest trade to trend, and that would keep, well, for me it is right now, that would keep the implied volatility in an upward trend as well. So you see how the price is dropping and the implied volatility is rising. So I don't want to see the price go up, because that would mean implied volatility would go down, and I don't want to trade options that are against the trend in the IV. That's what's really important, is the trend in the implied volatility. Playing puts to the downside while IV drops was really hard this week, and I really only made money, or I made the best money, when the implied volatility was in my favor. So it's important to remember that as well. So a mild little hiccup, a bump up, or a prolonged inverted head and shoulder setup would be it'd be hard to trade. So I'm going to be careful watching Monday's open. Monday's open is going to be a big signal. Now, the reason why the Three Crows is so bearish is because we only need to get below 1610 in order to establish more continuation downward, right? So morning dump, just a nasty sell-off like we've been seeing, like this, would be, it could happen, right? It could happen. And this would be an absolutely fantastic time to play puts. And it wouldn't surprise me if it just continued to dump. I bet you, though, that it would probably come down, be like, hey, look, fake double bottom, and then bounce a little bit before closing with a small tail. So those are our most likely scenarios, is an interaction with these two downtrends, the horizontal level of support resistance at 1697 and that recent low of 1610. So if you're a bear or you're a bull, there you go. If price starts to tank at open, I'm going to be buying puts because that implied volatility should continue to rise. There you have it. This is the best technical analysis on AMC that I've seen this weekend. It's all based on Bulkowski's identification criteria, his specific instructions on how to draw trend lines, and it identifies a candlestick pattern with a higher probability of downward breakout, with a target eventually leading to $8.98. There is an opportunity here for bullish reversal as well, but seeing as how the broader markets are dumping, AMC is likely to follow that trend and be pushed lower. You can see that the implied volatility has been dropping as the price declines as well, but is now in an uptrend as the price continues to move lower. For me, this is a signal that the downward breakout of the bear flag is valid. I think that we're going to see the RSI turn around from where it currently is at, and I'm going to turn on the daily actually here. You can see it's already kind of doing it, right? The RSI has already left this bouncy zone it was in through there. It's starting to say, hey, time to go down. And the drop from yesterday wasn't as pronounced as the prior 2 days, so the RSI is starting to swoop. I would just expect a dump. Something hard and heavy like this. If that happens tomorrow, buckle up, because it's not going to stop there. It's likely that the RSI will again plunge into oversold. Very likely. You see we have an instance of oversold here. It wouldn't surprise me at all to see the RSI go back into oversold for a second time before coming back up and out. And a dive to $9 would facilitate that move very nicely. And if that low is above the previous low back here at 1775, perhaps we only drop, I don't know, whatever that is, to 27, this would form a bullish divergence in the RSI and would then signal a bounce. So this is what I think I'm seeing. I think we could see the price work its way down, probably in a measured move, probably something like that, and then rebound from there. And this is really what I've been waiting for a long time. Back here, when the price started to move sideways, I stopped day trading because I knew it was going to move sideways for a while. I didn't think that it would go sideways for as long as it did, but I did identify that we were going to just be bouncing around for a bit. And when the price moved down to 1290, I got super bearish and I said, this is it, we're going to move down. And then, of course, the price broke out and up. And this is why I'm always so wary of AMCs, because when it looks like it's about to make a continuation, it just suddenly turns and flips and then explodes to the upside. But seeing as that has already happened, and we are now on the downtrend and recovering the momentum that we saw from the initial push down, I think that we are finally going to see the actualization of a sub 10 price. And it's the bounce from this price that's going to matter the most. There is a lot of short interest. I know there's a lot of short interest. And it's not that I'm waiting for a short squeeze, it's that it's an inevitability that when the price does get that low, that some shorts or some short positions will be closed. And that will help generate a little bounce. And it just depends on how many calls get exercised down here in that bounce. So if some shorts close and there's some upward pressure and a bunch of calls run into the money and those calls get exercised, then that could send the price much higher, much higher. And what that recovery pattern would look like is unknown. If there is a measured move down here, the measured move down is a great opportunity to establish a left shoulder. If we do enter a vertical run down, like I think, vertical runs are incredible because they have slingshot potential, right? So let's say maybe our measured move down has a super strong move, and then we get this V. That would be a good move too. I would then expect some sort of flag to appear, okay? I think this would look really good. This is really what I'm looking for in AMC. And then, of course, if that were to happen, we'd be trying to figure out what the next price would be, and then we'd be back up in the 20s. Not gonna lie, that's really speculative, but this would make sense. This would make a lot of sense. You know, it's hard to say what the price is gonna do. Like, who knew we were gonna get this weird rounding top, right? That's just weird. And then it was right after this ugly double bottom too, right? Ugly double bottom, weird double top, and then you know, after a dump from up here in the 30s, we had a run up to the 30s. It was a perfect mirror, all right? Perfect mirror from there to there. Let me delete this. You know, from price high to price low to bottom to topping to back to the original price. Look at that. Ooh, it's marvelous, isn't it? So here you go. I guess what I just kind of drew over on the far right of the chart was another measured move down like this with a similar V. That's kind of what I'm expecting to see, is something very similar to that occur over here. So that's what I have for today's analysis. I went over the bear flag, really carefully looked at those trend lines, took a hard look at the three black crows. They're three identical crows. They're long black days. They're three identical crows. I need to get that terminology right. And is this long? It's a long video. It's 27 minutes. I hope that this analysis is helpful. I'm really just cataloging my thoughts. If we do see this dump, as I believe is likely, I'm gonna have a good time trading this rising implied volatility trend. We are gonna need to see volume maybe tick up a little bit. It doesn't take a lot of volume to really send the price down, but as you can see, the rising volume trend can be a great indicator in that sort of a situation. So we haven't really seen that kind of a rising trend yet. I mean, a little bit. So a higher volume day, a red day tomorrow with a low and a close below 1610. It's going to be absolutely it's going to be a fall. The price will probably plummet from there. So that's what I have. Happy trading.